The market has Opendoor Technologies Inc. trading at a pre-market price of $4.93, reflecting a sharp move down of minus 24.68% from yesterday's close of $6.55. This is not the intraday swing we usually dissect, but rather the immediate and brutal reaction to the company's Q3 earnings report released after the close, which now frames the entire narrative around the stock. The immediate expectation has been shattered, but here's the contrarian take that forces a deeper look. The market is punishing Opendoor for its Q3 miss on revenue and a wider-than-expected net loss, but the real story is in the management's new, highly specific path to profitability, Opendoor 2.0, which suggests the company is finally shedding its growth-at-any-cost skin. The stock's massive volatility. Remember, this is a stock that was trading at $0.51 just over a year ago and spiked to $10.87 in a speculative frenzy, is simply the price discovery mechanism slamming into the cold hard wall of execution risk. Most investors, particularly those on platforms like Robinhood or engaging in self-investing, see a deep cut and panic, but sophisticated players and institutional brokerage accounts are now sifting through the details of the strategy pivot for a long-term signal that the retail momentum obscured. The immediate technical damage is severe. The stock is gapping down significantly on massive volume, a clear capitulation event following the earnings and a subsequent share offering announcement. The fact that the stock is now being offered below $5 puts it back in a highly speculative zone, erasing much of the rally fueled by retail excitement over the past few months. Key institutional holders like Vanguard Group Inc., VTSMX, and BlackRock Inc., who hold substantial passive stakes, are simply reflecting the market price, but the active institutional traders are likely driving this volume spike. The sheer velocity of the move suggests short-term traders and those who bought into the meme narrative are rapidly liquidating positions. We are seeing a classic example of fundamental reality clashing violently with market expectation. The anticipation was that Opendoor had navigated the worst of the high interest rate environment, a view fueled by its positive adjusted EBITDA in the prior quarter. The reality? Q3 revenue came in at $915 million, a sharp sequential decline and below estimates, with a net loss widening to $90 million or $0.12 per share, which was worse than analyst consensus. This revenue decline, the steepest in a couple of years, is the core of the market's disappointment and the primary driver of this pre-market slump. The daily trading swings leading up to this earnings release were already choppy. For the 2 months prior to this earnings release, Opendoor stock had mainly moved sideways, indicating a cautious wait-and-see attitude. This followed a blistering rally that started in the summer, pushing the stock up nearly 900% in 6 months on the back of housing market optimism and a short squeeze dynamic, reminiscent of the speculative trading seen in other highly shorted names. Short interest, while slightly down from its peak, remained elevated at around 22%, which means this morning's price action is a painful win for the bears and a potential margin call event for the highly leveraged bulls. The question now is not about a quick rebound, but where the stock stabilizes as the new narrative takes hold. The technical support levels from the prior run-up are now largely irrelevant, with the stock likely to seek support near where the big institutional buying interest previously materialized, which is significantly lower than this current pre-market price. Those using self-investing tools offered by Interactive Brokers or Fidelity may find their stop-loss orders being executed at a much wider than anticipated range, highlighting the danger of high-volatility names. To truly understand the reality that just hit the market, we need to focus on the company's strategic shift. Opendoor's core business model, iBuying, centers on buying homes directly from sellers, conducting light repairs, and then reselling them. This is a capital-intensive, high-volume, low-margin business that acts as a market maker for residential real estate. It's predicated on 3 things: razor-sharp pricing algorithms, its automated valuation model, or AVM, quick inventory turnover, and a stable to appreciating housing market. The last last two conditions have been severely strained by rising mortgage rates and general housing market uncertainty, leading to the financial performance we saw in Q3. The company's inventory at the end of the period, while lower, is still a risk, as is the time it takes to sell a home. The new CEO, Kaz Nejitan, has explicitly stated, "We are refounding Opendoor as a software and AI company," and is making a decisive break from the past by focusing on a clear path to break-even adjusted net income by the end of next year. This is the unexpected insight. The company is now prioritizing software and efficiency over simply volume. The Opendoor 2.0 strategy is built on three measurable management objectives: scaling acquisitions, improving unit economics and resale velocity, and building operating leverage. Management is essentially telling investors that they are shifting from relying on the macroeconomic environment to relying on execution and proprietary technology, including AI integration, to drive unit profitability. They are providing specific metrics for shareholders to track, such as the number of homes under contract and the percentage of homes on the market for over 120 days. This level of granular accountability is something new and powerful. While the revenue miss is a significant headwind, this forward-looking strategic clarity is what separates the panic selling from the long-term opportunity. If the company can consistently hit its execution goals on a monthly and quarterly basis as promised, the market may re-rate the stock as a technology platform rather than a cyclical real estate flipper, which would justify a much higher multiple down the road. This is the expectation versus reality tension at its peak. The immediate reality is a disastrous quarter, but the new expectation, driven by management's plan, is a leaner, more technology-focused business model. Historically, Opendoor has been a story of rapid growth followed by painful contraction. In 2021, at the peak of the housing boom, the company's revenue exploded to over $8 billion. As the real estate market froze in 2022 and 2023, the company saw its revenue drop substantially and losses balloon due to homes bought at peak prices losing value. The sheer volatility in its inventory management and cost of capital has always been the primary risk. The core product, Sell to Opendoor, gives sellers a quick, certain, and all-cash offer, bypassing the traditional, lengthy, and uncertain process of working with an individual brokerage. The value proposition is convenience for a fee. The company also offers List with Opendoor, connecting customers with partner agents and offering an instant cash offer as a backup. The integrated services such as title insurance and escrow are low volume but higher margin ancillary services designed to improve the unit economics of each transaction. Competitors like OfferPad Solutions Inc. and Zillow, which tried and failed at iBuying, have struggled with the same dynamics, proving that the iBuying model is incredibly hard to execute profitably at scale in a volatile market. The new strategy acknowledges this difficulty by placing the focus squarely on technology-driven efficiency, something that platforms like SoFi Invest or Schwab Intelligent Portfolios stress in their own digital-first approaches to finance. Looking forward, the future outlook for Opendoor hinges entirely on execution against the Opendoor 2.0 plan and the broader direction of interest rates. The single largest external catalyst would be a meaningful and sustained decline in mortgage rates. Lower rates would immediately increase homebuyer affordability, accelerate Opendoor's resale velocity, and improve the return profile on their inventory. The risk, of course, is that rates remain elevated or even rise again, forcing the company to continue to absorb higher holding costs and take greater losses on sales to maintain turnover. Internally, the key catalyst is the success of their AI and software initiatives. If they can demonstrate that their new AVM and operational technology can consistently generate a higher contribution margin per home, the market will eventually forgive the current losses. Conversely, failure to deliver on the break-even adjusted net income by the end of next year target will likely lead to another painful re-rating of the stock. Institutional analysts are skeptical, with several firms maintaining sell or underperform ratings and price targets well below the current trading range, highlighting a clear divergence between the street's fundamental caution and the lingering optimism of the retail investor base. The market today is saying the risk is too high given the latest numbers, but the management's new commitment to a software-first approach offers a potential, albeit at high risk, pathway to a different future. It's a moment of profound uncertainty for the Opendoor stock, one where fundamentals have taken a sledgehammer to sentiment. I want to know where your analysis leads you. Comment below with what you think the most critical number is for Opendoor's future: the average days their inventory sits on the market or their adjusted EBITDA margin. The stock's ultimate valuation depends on which of these metrics improves fastest. In summary, the expectation that Opendoor was weathering the housing storm proved to be premature, resulting in a disastrous Q3 report and a massive pre-market sell-off. The reality is a company in full strategic retreat and realignment, pivoting to a software and AI-driven model to force its way to profitability regardless of the housing cycle.